Good morning. Good morning, all of you. Today, we will talk about banking and finance, chapter 4, types of risk at financial service institution. The chapter outcome, this chapter is covered the types of financial type of risk facing at the financial service institutions, especially. Right. So one of the major objective of financial management, finance institution is to managers is to increase their financial institutions return for its owners. So not only financial institution, so we take whatever the institution, whatever the organization which are focusing on making profit, they try to minimize the risk while they are making profit to the owners. The increased return often come at the cost of increased risk, which comes in many forms. You might study studied in other subjects, especially financial management. The return is always associated with risk. Without facing risk, without taking risk, it's hard to make profit. If you want to make high return, you have to face high risk. But in this vein, there are a lot of risk in financial institutions, but we focus mainly the common risk. Number one, credit risk. Number two, liquidity risk. Number three, interest rate risk, market risk, off-balance sheet risk, foreign exchange risk, country or regional risk, technology risk, operational risk, and insolvency risk. Among many risks, so these 10 risks are common for every organization, and these risks are more severe. Right? All financial institutions will have we have to manage this risk. Let us look at one by one. The credit risk mean um, the main business of financial institution, right, to make profit is what they give loan to its customers. They give loan to its customers. It may be short-term loan, medium-term loan, or long-term loan. For that loan, the bank or financial institutions charges interest. The interest is a major income, right? The major income of the financial institution, right? When the company or when the bank or financial institutions give loan to its customers, sometimes the customer may fail to settle the loan back to the lender. The borrower failed to settle or pay back the money they have received. They may fail to pay back the interest or principal or both. Credit risk is the risk that the promised cash flows from loan and securities held by financial institutions may not be paid in full or half. Some portion has paid, some portion not paid. Right? The financial institutions that make loan or buy bonds with long maturities are relatively more exposed to credit risk. Short-term loans, right? Short-term loans having no low risk, low credit risk. The short-term loan mean the bank or financial institutions give this loan for 1 day, for 1 week, 1 month, 6 months, 1 year, maximum 1 year. So it's easy, right? The bank manager can predict the solvency of the customer. But if the bank gives loan for 10 years, 20 years, it's very hard to predict the future of that customer. Therefore, it's easy, right? It's easy to manage short-term loan credit risk, right? Based on their credit worthiness or financial capacity of the customer, the bank can decide whether we can give the loan or not. When banks give short a long-term loan, right, at the time of getting loan, application of loan, the customer may be high worth. But after 5 years, 10 years, it's very hard to predict. So that's why long-term loans having high credit risk than the short-term risk. That's why banks charges high rate of interest, right? So that's the banks, thrift saving and loan association and insurance companies are more exposed to money market, right? Money market mutual funds exposed than money. So it's money market mutual funds mean short-term loans and properly cost insurance companies, causality property, causality insurance companies. Many financial claims issued by individuals or corporations have limited upside return with high probability, low downside risk with low probability. A key role of financial institution involves screening and monitoring loan application to ensure only the creditworthy receives loan. Financial institutions also charge interest rate commensurate with the riskiness of the borrower. So, to mitigate this credit risk, when and the customer apply for a loan, they thoroughly check the creditworthiness of the customer, loan applicant. If bank satisfied, the customer is able to settle the loan without any fail, then only they will approve the loan. If they identified, yes, there are some potentials uh, to not to repay the money to the bank back, they may charge high interest on that customers because of the bank take some sort of risk to compensate that risk. The bank may charge a little high interest. The effect of credit risk are evidenced by charge-offs. The bankruptcy law make it more difficult for customers to declare bankruptcy. Earlier period, individuals take loan from the bank, especially from the government banks, a big amount of money, and they simply say, I'm bankrupted. I'm simply bankrupted. So they are not able to settle the loan. But nowadays, it's very hard to declare bankruptcy. The court may order to sell or court may order to investigate all of the properties, whether it's deliberated or false statement or truth statement, right? And sometimes there may be a collision between the bank manager and the customer who declares bankruptcy. So there are a lot of deep investigation may going on. So it's very hard nowadays to declare bankruptcy. Financial institutions can diversify away some individual firm-specific credit risk, but not systematic credit risk. Right? Here, when the few applicants may submit forgery documents to get loan, the bank will get alerts. They are carefully screened the loan application. Through this way, the bank can manage individual or firm level credit risk. But it's very hard to eliminate this systematic credit risk. What does it mean, systematic credit risk? For example, in our country, COVID-19. COVID-19, followed by economic crisis. Many business unable to survive during that period, especially those who got vehicles on leasing and business loan. So those people, those business people, an individual face hard times. So therefore, it's very hard to settle that money. It is not applicable to one or two individual customer or individual firm. It's common for all. It's country-wide, sometimes international-wide, global-wide problem. So this is systematic. So banks, it's very hard to manage, very hard to diversify this kind of credit risk. Firm-specific credit risk is the risk of default for the borrowing firm associated with the specific type of project risk taken by that firm. When individuals or companies apply for a loan to the companies, to the bank or institutions, they are come up with project. They need money for certain project financing. When that time, the bank officers, credit officer thoroughly check the viability of making profit of that project. So this is case by case. By doing so, the banks and financial institutions can assess their risk. If it is high risk, no uncertainty, the bank manager, the credit officer may stop or they can deny to provide loan. Systematic credit risk is the risk of default associated with general economic wide or macroeconomic conditions affecting all borrowers. Number two, liquidity risk. Liquidity risk means the bank should maintain sufficient amount of cash, liquid cash in their hand. For what purpose? Depositors visit to the bank to withdraw their money. For that, they have to have sufficient amount of money in their hand. On the other hand, new customers apply for loan, good customers, well credit worth customers, and there are a lot of opportunities for the company, financial institutions to make profit. If they have no sufficient money in their hand, they may lost that customer, worth customer. So that they have to keep sufficient amount of money. If the bank keep a big amount of money in their hand, they may lose interest income. If they fail to keep sufficient amount of money in their hand, they may lose their credit rating. They may lose their trust among their depositors, so that the bank or financial institution have to make a balanced approach. So they have to keep appropriate optimum amount of money in their hand. So liquidity risk is the risk that a sudden and unexpected increase in liquidity withdrawals may occur and financial institutions to liquidate assets in a very short period of time and at lower prices. So some customers suddenly visit the bank and may request a big amount withdrawal. That time, if they have no sufficient money in their hand, they have to face a lot of difficulties. They have to get loan from other banks, like interbank whole money market. For that, they have to make a big amount of interest, or they have to sell their assets, trading assets in the share market. They may invest at many shares. If they want money suddenly, the banks have no options other than selling that value instrument on that day, the price less than market price. That may happen. Day-to-day withdrawals by liability holders, especially the deposit holders, are generally predictable, right? Normally, bank managers can predict. There are seasons. For example, during the festival seasons, many customers, many depositors uh, withdraw their savings, right? On other periods, normally they are deposit money, no much withdrawal. So that time, the bank manager have to keep a big amount of liquidity in their bank. Unusually large withdrawals by liability holders can create liquidity problem, right? Sometimes withdrawing 1 million, 2 million, is not a matter, right? Every day. But there are some customers suddenly visit the bank and they may withdraw 50 million, 100 million, right? Withdrawals. That instances, bank does not keep this big amount of money in their hand. The sudden withdrawals. Normally, these kind of things uh, may happen when customers try to buy a big valuable real estates, or the depositors who are living in abroad, once they come to Sri Lanka, they may withdraw that money to buy some properties. So this may happen. The cost of purchased and borrowed fund raises for financial institutions, right? So they have to suddenly arrange money for them. For that, they have to face a lot of difficulties. They have to borrow. An institution have to borrow, or they have to sell some of their assets. Supply of purchased or borrowed fund declines. Finance institutions may be forced to sell less liquid assets at higher sale prices. If they sometimes, right, illiquid assets. There are liquid assets in the stock market, as well as there are liquid assets, mainly the buildings, real estates. Those are illiquid assets. It takes time to sell that properties. Interest rate risk. In the market, interest rate is fluctuate over time, right? Uh, for example, for some period, bank may charges low interest rate or low interest rate. Suddenly, the interest rate may increase, but the bank gives loan for a long term, 10 years loan, fixed interest rate. When the bank gives loan during the period of low interest rate for 10 years loan, right? So after 1 or 2 years of granting loan, the interest rate may go up to high interest rate. So that time, the bank cannot change the fixed rate, the interest rate of that customer. So the bank may face a lot of difficulties. But when the interest rate increases, for depositors, to attract depositors, bank has to pay high amount of interest. So that time, the gap between the interest charged to the customer, borrower, and interest paid to the depositors may be a problem, right? The gap maybe reduces. At that times, high risk to the banks. Interest rate is the risk incurred by an financial institution when maturities of its assets and liabilities are mismatched and interest rates are uh, volatile, right? Asset transformation involves a financial institutions issuing secondary securities or liabilities to fund purchase of primary securities or assets. If financial institutions' assets are longer term than its liabilities, it faces refinancing risk. Refinancing risk mean, right? Here, um, take this one. Uh, you receive a deposit for 10 years, right? 10 years deposit, 10 million deposit you received from your customer, right? So this is a 10 years, 10 years, 10 years. If you invest this money for 1 year loan or 1 year securities, right? This time the interest rate may be 5%, 5%. After 1 year, you have to withdraw this money, right? Then the next 1 year, the interest rate maybe increases to 7% or 8%. So that time you may happy, right? You may happy. Sometimes they may go, right, 2% or 3% interest rate. So it's no, this time the bank may face difficulties, right? Uh, they're getting lower interest income, right? If they give the long-term loan, right, rather than making 1 year loan, if they're making 10 years loan, right, for 10 years deposit, they may uh, using 10 years deposit, they may provide 10 years loan. So they may fix the interest rate, say 8% interest, 8% interest. So here there's no refinancing. Refinancing mean here reinvestment risk. Sorry, this is reinvestment risk. Reinvestment risk. Reinvestment risk mean so they are having a long-term deposit, right? Long-term finance, but they use short-term investment. So every year they have to find new investment opportunities. This is called reinvestment risk. It's very hard. Sometimes other way around. So they may have only 1 year deposit from the by the customer, by the depositor. Only 1 year deposit. If you give 10 years loan by using this 1 year deposit, say 10 million, 10 million deposit by one customer for 1 year, right? By using this money, if you give a 10 years loan, you may face difficulties, right? So after 1 year, the depositor visit to the bank for withdrawal. That time, you cannot recall your borrower to pay money, right? Anyhow, the manager has to make arrangement to settle this 10 million, and the manager has to find another way or another customer who deposit 10 million. So this is called refinancing risk. So therefore, the manager has to match short-term deposit should be used to make 10 short-term deposit has to be used to short-term loan, long-term deposit has to be used to provide long-term loan. So this is what matching, right? Maturity matching concept. Here, in financial institutions, assets mean the loan, right? The loan are longer term than its liabilities. Here, liabilities mean deposits, short-term with short-term deposit, but long-term loan. It faces refinancing risk. So they have to identify a depositor, new depositor, right? Another way around, the risk that the cost of rolling over or reborrowing fund will be raised above the return being earned on the asset investment, right? When they try to find another depositor, they have to give high interest rate to attract a new depositor. They have to promise high interest rate. So it's risk, it's high risk. If and financial institution assets, right? Assets, a loans are short term, so 1 year loan. Then liabilities, deposits, right? So 10 years deposit and 1 year loan, right? It faces reinvestment risk. They always do every year they have to find new investment opportunities. The risk that the return on fund to be reinvested with fall below the cost of fund. Cost of fund mean the amount of interest, the rate of interest paid to its depositor, right? Then then uh, the amount of the rate of interest received from the loan, uh, the borrowers. All financial institutes face price risk. That's mean or market value risk. Prices mean uh, in the stock market the prices maybe go up and down, right? Especially in the stock market or bond market. The risk that price of a security changes when interest rate changes. Right? So you might study in financial management. There is a relationship between uh, uh, discount effect and the discount effect coupon rate. Right? Discount factor and coupon rate. Coupon rate mean what? The rate of interest. So that rate, the changes in the market interest rate may impact on their value of the stock or bond. Financial institutions can hedge. Hedge mean the techniques to minimize the risk. Hedging means the techniques, tools and techniques used to minimize the risk. Finance institution can hedge or protect themselves against interest rate risk by matching the maturity of their assets and liabilities. Right. To reduce this kind of risk, what finance institution do is short-term deposits used to provide short-term loan. Long-term deposits used to support long-term loan, right? That's called what? Matching. Matching assets and liabilities, maturity matching of liabilities, assets and liabilities. This approach is inconsistent with the assets transformation function. So market risk. Market risk is the risk incurred in trading assets and liabilities due to changes in interest rate, exchange rate, and other asset prices, closely related to interest rate and foreign exchange risk. So trading activity, that is market risk is the incremental risk incurred by a financial institution. In addition to interest rate or foreign exchange risk caused by an active trading strategy. So, in the stock market, the impact of exchange rate, the impact of interest rates, those are short term, right? Sorry, those are long term. So interest rate and exchange rate are not suddenly change significantly. But the trading strategies. So they may use lot of technical analysis, uh, and they use some margin technique. So they may use different techniques to make short-term profit in the stock market. So that trading strategies may impact stock prices. That's why some stock prices go peak rocket at the speed of light, unexpected increases and unexpected down. So no one knows what the reason. Actually, the scene behind on that unreasonable, right, activities are trading strategies by most market manipulators. Financial institutions trading portfolios are differentiated from the investment portfolio on the basis of time horizon and liquidity. And the financial institutions not invest all of their money in one securities or one debt or one stock. They make portfolio. Some are long term, some are short term. Some are in one company, some are in another company, right? So they diversified well their portfolio to minimize this kind of market or trading risk. The trading assets, liabilities, and derivatives are highly liquid. Investment portfolios are relatively illiquid. Investment portfolios are liquid that are usually held for long-term period of time. For example, real estate, the land or building, right, machineries. So those kind of things are long-term investments. So it takes time to liquidate. So illiquid assets. Declines in traditional banking activity and income at large commercial banks have been offset by increases in trading activities and income. Decline in underwriting and brokerage income at large investment banks have been offset by increases in trading activity and income. So earlier, right? Investment banks or merchant banks, they uh, received a big amount of income by providing traditional banking services like underwriting services, brokerage, right? They engaged in that activities and earn profit. But nowadays, they focus their business on trading of assets and liabilities, trading of stocks, trading of stocks, rather than waiting for rather than working for commission, right? They are working seriously on making profit by trading assets, securities in the market. Actively, actively managed uh, funds, market funds are usually exposed to market risk. Financial institutions are concerned with fluctuation in trading account assets and liabilities. Value at risk, value at risk, and delay the daily earning at risk. Daily earning at risk are measures to assess the market risk exposure. So day to day, every day, the risk may changes. Sometimes the stock prices go up, right? Suddenly, the share of a particular stock may go down unexpectedly. So the risk, some are having much risk, some are having less risk. The companies with strong fundamentals, like in our country, John Keel's, HNB, Commercial Bank, mostly top 20 companies, SNB 20 is a companies. So those are fundamentally strong companies. So they are facing less risk. So their value all the times are high. So the investors, especially the banks, when they decide to whether buy or sell or hold the particular asset, always they look at value at risk. There's a formula to calculate value at risk and a daily earning at risk. So some people do, not some people, many investors in engaged in daily trading. It's called intra trading. Intra trading activities mean um, they buy and sell stocks within a day. Within a day, they buy stocks at lower price and sell it for higher prices within a day, not a long-term investment. So those are active investors, intra traders. So they are facing high risk. They are facing high risk. In the morning, they purchase assets, but in the evening, the price may go down. So they may end up with loss. Sometimes other way around, right? That is daily earning at risk. Value at risk for long-term assets, daily earning at risk for short-term asset intra-trading. Market risk exposure has caused some highly publicized losses. The failure of 200 years old British merchant bank brings in 1995, right? Not only the risk is not only for small companies, you know, for the long, right? Well-aged companies, well-established companies also may face losses. 7.2 billion in market risk related to loss of society generally in 2008. So these are the examples that well-established companies may got severe risk. Off-balance sheet risk. Off-balance sheet risk mean some activities, right? Some risks cannot be disclosed in the financial statement, especially balance sheet. Court cases, right? CBA court cases against the bank by the government or by the customer. These court cases, if bank lose in the court case, the bank may has to pay a big amount of money, or sometime the license may be cancelled. Bank license could be cancelled, may happen. So that kind of things may not included in their balance sheet. They're not disclosed. So these are off balance sheet, behind the balance sheet. Off-balance sheet is the risk incurred by an institution as a result of activities related to contingent assets and liabilities. Contingents. It may happen. There are chances to may happen. Off-balance sheet activities can increase financial institution interest rate risk, credit risk, and foreign exchange risk. Off-balance sheet activity can be also used to hedge or reduce financial institution interest rate risk, credit risk, and foreign exchange risk. Large commercial banks, in particular, engage in off-balance sheet activities. On-balance sheet assets of all U.S. commercial banks total 10.8 trillion in 2007. The example, the national value of off-balance sheet item total 108.6 trillion in 2007. So these are the examples of this example that signifies the off-balance sheet cases. It may not disclosed in the balance sheet, but it may happen behind the scene. Only financial activities disclosed in the bank's and statement, but the non-financial activities, but it causes a huge loss, sometimes huge profit that may not disclosed in the balance sheet. Off-balance sheet activities can affect the future shape of financial institutions' balance sheet. Off-balance sheet items become a balance sheet item only if some future event occurs. So the fourth case, the judgment gives to pay a big amount of money to its customer. Unexpected event, court order. Then it makes unexpected liability in the balance sheet. Suddenly emerged that liability. Letter of credit is a credit guarantee issued by financial institution for a fee on which payment is contingent on some future event occurring, most notably default of the agent that purchases a letter of credit. Right. When import-export businesses, letter of credit is unavoidable. Say one importer requests letter of credit from a bank to make import. The bank gives a guarantee that a particular customer able to settle your money it's a promise given to the exporter from another country. In case the importer fails to settle that money, the bank has to take responsibility. So this is off-balance sheet activity. Other examples include loan commitments by bank, mortgage servicing contracts by saving institutions, positions in forward futures, swaps, and other derivatives held by almost all financial institutions. Every financial institutions having off-balance sheet activities. So it's very important to monitor that kind of things. Foreign exchange risk, the foreign exchange rate may go up and down. So this movement of up and down severely impact the export import business. Not only that, the banks as well, because banks may involve in settlement of their settlement in terms of foreign currency. Say they made an agreement between the customer and the bank at the fixed rate. For example, $1 for 108 rupees. After 6 months, the dollar may be 360 rupees. So that time the bank has to pay according to the agreement. So that exchange rate may severely impact that financial institutions. Foreign exchange risk is the risk that exchange rate changes can affect the value of the financial institution's assets and liabilities denominated in foreign currencies. Foreign financial institutions can reduce risk through domestic foreign activity or investment diversifications. In some cases, the banks may invest in other countries. Say, American company may invest in Sri Lankan companies, its assets, due to the depreciation of our country currency, Sri Lankan rupees against US dollar, the value expressed uh, in terms of a dollar may be reduced, right? Severely reduced. The balance sheet item may got a lower amount. So this is severe impact balance sheet position of a parent company. Finance institutions expand globally through acquiring foreign firms or opening new branches in foreign countries, investing in foreign financial assets. American company may invest in Sri Lankan stock market or due to the uh, foreign exchange, right? Fluctuation, the value of assets may go down. US dollar terms assets converted into Sri Lankan rupees assets. Sri Lankan rupees go down. Then no American investors willing to invest in Sri Lanka. But Indians, Sri Lankans may willing to invest in countries like Japan, America, and other countries because always the local currency are devaluated. If they invest in US dollar, even the investment does not make any profit, but due to the changes in exchange rate, they can get some sort of profit. Return on domestic and foreign direct and portfolio investment are not perfectly correlated. Underlying technologies of various economic differences differ. Exchange rate changes are not perfectly correlated across countries. A net long position in foreign currency. Long position mean so it's some to give. They have to give. A net long position is a foreign currency involves holding more foreign assets than foreign liabilities. Long position. That so um, we have the big amount of assets than liabilities. That's long position. The wealth. Financial institutions losses when foreign currency falls relative to US dollar. Foreign financial institutions gain right profit get profit when foreign currency appreciate related to the US dollar. Say for example, we have assets. You have US dollar in your hand, right? US dollar in your hand, 1 million US dollar in your hand, right? Then the rupee has devalued. Oh, uh, the the US dollar has appreciate, right? Appreciate local currency depreciate and US dollar appreciate. Then you may got profit, right? You may happy. Earlier, last 2 years ago, the US dollar 10 million mean that time US dollar 108 rupees, then 180 billion, right? So that amount of money you may get. But now almost double. And right, net short position mean we have more liability than assets, foreign assets. Net short position in a foreign currency involves holding fewer foreign assets than foreign liabilities. So we have high amount of foreign liabilities than foreign assets. Financial institutions gain when foreign currency falls relative to US dollar, other way around. Financial institutions losses when foreign currency appreciates relatively US dollar. Yeah. And financial institution is fully hedged if it hold an equal amount of foreign currency denominated assets and liabilities that have the same maturities, right? So as credit risk management, uh, to hedge this kind of exchange risk, the banks should keep an equal amount of assets and liabilities with same maturities. Country or sovereign risk, right? Sometimes, nowadays when you look at the US and China, US and China, what happened? Uh, they are charging additional taxes mutually. America also imposes tax on Chinese product. China also imposes tax against American product. So this is not controlled by a financial institution or a particular company in China or USA. This economic war may spread out through all the world, right? So this is what sometime, for example, if America declares whole Chinese assets are frozen, right? Mm, no American companies cannot make any payment. American company cannot send any payment to China. So if Donald Trump uh, announced like this, finance institutions in China may face a lot of difficulties. Right? This is due to what? The government policy. Sometimes government collapse, bankruptcy in Sri Lanka. Many countries given loan to Sri Lankan government. But Sri Lanka face economic crisis, then the bankrupt. They are unable to settle that money to the lenders. So that is what. So it's very for that countries, it's very hard to collect money from the country, Sri Lanka. And also government has stopped paying of the large amount of foreign outflows, foreign settlement payment. A country of sovereign risk is the risk that repayment from foreign borrowers may be interrupted because of interference of a foreign government. The Chinese government, Chinese financial institution may be affected by the announcement of US president. It differs from credit risk of financial institutions' domestic assets. So with domestic assets, financial institutions usually have some recourse through uh, bankruptcy courts. Financial institutions can recoup some of their losses when defaulted funds are liquidated or restructured. Foreign corporations may be unable to pay principal and interest even if they would decide to do so. Right? American company is willing to settle the money to the Chinese bank, but government has stopped. But American company like to do that, but government stopped. Foreign government may limit or prohibit debt repayment due to foreign currency shortages or adverse potential events like a country economic crisis. Thus, uh, and financial institutions, claim holders may have to little or no recourse to local bankruptcy courts or international claim of courts. So measuring sovereign risk includes analyzing the trade policy of foreign government, the fiscal stance of foreign government, potential government intervention in the economy, the foreign government's monetary policy, capital flows and capital investment, and the foreign countries' current and expected inflation rates, the structure of the foreign country's financial system. Right. So when to hedge this kind of risk or reduce this kind of risk, uh, especially country or sovereign risk, the financial institution has to consider these aspects. Right. These aspects. Right. Then technology or operational risk. Right. Nowadays, the banks are interconnected. They are heavily depends on supercomputers or the server. Mostly all computers are interconnected, right? So think a situation, if someone hack the bank server, what will happen? Or think a computer, sorry, the bank's primary server fails down, what happened? Or virus effect on that server, the main computer, what happened? Cybercrime. So the technology, there are some what kind of interruption in their infrastructure. Say ATM machine, ATMs wrongly, uh, right? They paid the credit or debited in a wrong account. So what will happen? So these are the issues arise due to technology or operational risk. Technology risk and operational risk are closely related. Technology risk is the risk incurred by a financial institution when a technological investment do not provide anticipated cost saving. Right? Why do financial institutions establish a big amount of money to buy new CDMs, cash deposit machine, ATM, cardless payment, credit card payment system, online digital banking system? Why? To save some sort of cost. They are trying to reduce operational expenses. Sometime after establishing the system, the cost may be increased unexpectedly. So there is the major objective of technological expansion are to allow the financial institutions to exploit potential economics of scale and scope, right? They want to reduce their cost, lowering operating cost, increasing profit, capturing new market. That's why they are establishing new digital banking points. Operational risk is the risk that existing technology or support system may malfunction or break down, server breakdown, right? The BAS defines the operational risk as the risk of loss resulting from inadequate or failed internal processes, people, and a system of or external events. That's operational event. Insolvency, right? Insolvency. The banks cannot settle their obligations to its uh, liability holders. Insolvent, bankrupt. Bank become bankrupt sometimes. Many banks bankrupt in America in 2007, 2008. It's called global financial crisis, especially the Lehman Brothers bank, largest bank in USA, got bankrupted. Um, the insolvency risk is the risk that financial institutions may not have enough capital to offset sudden decline in the value of assets relative to its liabilities. Insolvency risk is a consequence or an outcome of one or more of risk previously described. So that we have discussed a different type of risk. So among these risks, one may be severely affect the bank due to that the bank got bankrupted. Say interest rate, market credit, off balance sheet, technological, foreign exchange, Soviet and liquid risks. Generally, the more equity capital to be borrowed fund and financial institution has to less insolvency risk it to expose to. No, the companies, the banks having more equity capital, having less chances of getting insolvency. The financial institution with more loan capital, borrowed capital or debt capital having more chance of bankruptcy. Both regulators and managers focus on capital adequacy as a measure of an institution's ability to remain solvent. Other risk and interaction among risk. In reality, all of previously defined risks are interdependent. Example, liquidity risk can be function of interest rate and credit rate risk. So one, right, is they are not, the risk are not standalone. They are interconnected. The relationships are more complex. When managers take actions to mitigate one type of risk, they must consider such actions on other risks, right? When the manager try to minimize one risk, that may impact, that may increase another risk. Changes in the regulatory policy constitute another type of discrete or event specific risk. Other discrete or event specific risks include war, revolutions, sudden market collapses, theft, malfeasance, and breach of fiduciary interest. Macroeconomic risks include increased inflation, volatility, and unemployment. Right. So please take this activity, select a financial institution in Sri Lanka and briefly explain each type of risk faced by selected institution with example. So please take this one and you submit this as an assignment, right? You have to submit as an assignment, right? So we will have a break of 10 minutes. So we will meet again at 11:10 or 11:15, right? 11. Please take a screenshot of this activity and we will next talk about risk management, right? We will meet at 11:15. Thank you.